Imagine you lend your friend $1,000. Your friend says, I will pay you $50 every year, and after 5 years, I will give you back the full $1,000. That is the basic idea of a bond. Simple. You lend money. Someone promises to pay you interest, and later they promise to return the original money. But here's where most people make the mistake. They think bonds are boring. They think bonds are only for retired people. They think bonds are just some quiet investment sitting in the background. But bonds are not just investments. Bonds are one of the main ways money moves through the world. If you do not understand bonds, you do not understand interest rates. If you do not understand interest rates, you do not understand mortgages. If you do not understand mortgages, you do not understand housing. If you do not understand government bonds, you do not understand government debt. If you do not understand bond yields, you do not understand why stocks rise, why stocks fall, why banks lend, why banks tighten, and why your money feels more expensive at different times. That is why today's video is called If You Don't Understand Bonds, You Don't Understand Money. My name is Edwin, and welcome to The Wealth Shift. Let's make bonds simple. A bond is basically an IOU. It is a loan. But instead of you borrowing money from a bank, you are the one lending money. You can lend money to a government, you can lend money to a company, you can lend money to a city or local authority, and in return they promise to pay you interest. That interest payment is often called the coupon. The amount you originally lend is called the principal, and the date when the borrower is supposed to pay back the principal is called maturity. So if a bond has a face value of $1,000, pays 5% interest, and matures in 10 years, it means the borrower is promising to pay $50 a year, then return the $1,000 at the end. That is the foundation. Bond equals loan, coupon equals interest payment, principal equals original money, maturity equals final payback date. Simple enough. But here's where bonds become powerful. Bonds put a price on time. If you lend money for 1 year, you want something in return. If you lend money for 10 years, you want more compensation because your money is locked up longer. If you lend money to a safe borrower, you may accept a lower interest rate. If you lend money to a risky borrower, you demand a higher interest rate. So bonds are really measuring two things: time and trust. How long will my money be tied up? And how likely is the borrower to pay me back? That is why government bonds from stable countries usually pay less than risky corporate bonds. It is not because investors hate higher returns. It is because higher returns often come with higher risk. The interest rate on a bond is not random. It is the market's way of saying, how much reward do I need to lend this money? And once you understand that, you start seeing money differently. Now let's talk about the part that confuses most beginners. Bond prices and interest rates move in opposite directions. This is the key lesson. When interest rates go up, existing bond prices usually go down. When interest rates go down, existing bond prices usually go up. At first this sounds strange, so let's make it simple. Imagine you bought a bond for $1,000 that pays 5%. That means it pays $50 a year. Now imagine that new bonds come out paying 7%. A new investor can now buy a new bond and get $70 a year. So why would someone pay full price for your old bond that only pays $50? They probably would not. To make your old bond attractive, the price has to fall. That way, the buyer gets a better return compared to the price they paid. Now flip it. Imagine you own a bond paying 5%. Then new bonds start paying only 3%. Your old bond is now attractive because it pays more than new bonds, so investors may be willing to pay a higher price for it. That is the seesaw. Rates up, old bond prices down. Rates down, old bond prices up. This one idea explains a lot of financial markets. It explains why bond funds can lose value when interest rates rise. It explains why long-term bonds can move more sharply than short-term bonds. It explains why investors watch central banks so closely. It explains why the price of money changes everything. Now let's make it even more practical. Why should a normal person care about bonds? Reason number 1. Bonds influence borrowing costs. When bond yields rise, borrowing often becomes more expensive. Mortgages can become more expensive. Business loans can become more expensive. Car loans can become more expensive. Credit can tighten. That means fewer people can afford big purchases. Businesses may slow down expansion. Consumers may spend less. Housing may cool. So bonds are not just Wall Street numbers, they affect real life. Reason number 2, bonds compete with stocks. Imagine safe bonds are paying very low interest. Investors may look at stocks and say, if bonds pay almost nothing, I may need to take more risk to grow my money. That can make stocks more attractive. But if bonds start paying higher interest, some investors may say, why take big risk in stocks if I can get a decent return from bonds? So when bond yields rise, stocks can feel pressure, not always, but often, Because every investment is competing for your money. Stocks, bonds, real estate, savings accounts, businesses, and cash are all competing. Bonds help set the baseline. Reason number 3. Bonds help explain government debt. When a government spends more than it collects, it often borrows money. One way it does this is by issuing bonds. Investors buy those bonds. The government gets money now. The investors receive interest. Later, the government must pay the bond back or issue new debt. So when people talk about national debt, interest payments, deficits, or government borrowing, bonds are usually part of the story. A bond is not just paper, it is a promise. And when governments issue many promises, the cost of those promises matters. Reason number 4. Bonds are part of many retirement portfolios. A lot of retirement accounts, pension funds, and investment portfolios hold bonds. Why? Because bonds can provide income, they can reduce volatility, they can balance risk, they can help investors avoid depending only on stocks. Stocks represent ownership, bonds represent lending. Stocks can grow more, but they can also swing harder. Bonds may be steadier, but they still have risks. A balanced portfolio often uses both. The goal is not to say bonds are better than stocks. The goal is to understand what role each one plays. Stocks are ownership, bonds are lending. Stocks ask, how much can this business grow? Bonds ask, will this borrower pay me back with interest? Different questions, different risks, different purpose. Now let's talk about the risks, because bonds are not magic. Some people hear bond and think safe, but safe compared to what? A high-quality government bond may be safer than many risky investments, but that does not mean every bond is safe. There are several risks. First, default risk. This is the risk that the borrower does not pay you back. A strong government may have low default risk. A weak company may have higher default risk. That is why risky borrowers must offer higher yields. They have to pay more to attract lenders. Second, interest rate risk. This is the risk that rates rise after you buy the bond, causing the bond's market price to fall. If you hold an individual bond to maturity and the borrower pays you back, this may matter less. But if you need to sell early, or if you own a bond fund, price changes can matter a lot. Third, inflation risk. If your bond pays 4%, but prices are rising faster than that, your money may lose purchasing power. You may receive interest, but what that money can buy may shrink. This is why inflation matters so much. Investors do not only care about the number they earn, they care about what the money can actually buy. Fourth, reinvestment risk. If your bond matures or pays interest, you may need to reinvest that money. But if rates are lower at that time, you may not be able to earn the same return again. So even safe income has timing risk. That is why understanding bonds means understanding trade-offs. There is no free lunch. More yield usually means more risk somewhere. Less risk usually means lower reward somewhere. Money always has a trade-off. Now let's connect this to your personal financial life. When you save money in a bank account, the bank may use deposits to make loans or buy financial assets. When you take a mortgage, your interest rate may be influenced by broader bond markets. When your retirement account owns a bond fund, your balance may move when rates change. When inflation rises, bond investors demand more compensation. When the central bank raises or lowers rates, bond markets react. When companies borrow to expand, they may issue bonds. When governments borrow to fund spending, they issue bonds. So bonds are everywhere. They are behind mortgages, behind pensions, behind retirement funds, behind government borrowing, behind corporate finance, behind interest rates, behind the price of risk. If stocks are the excitement of capitalism, bonds are the plumbing of capitalism, less flashy, but extremely important. And when the plumbing breaks, everybody notices. So how should a beginner think about bonds? Start with 3 questions. Question 1. Who am I lending money to? A government, a company, a city, a fund that owns many bonds? The borrower matters. Question 2. How long is my money exposed? Short-term bonds usually react less to interest rate changes. Long-term bonds can move more because the promise stretches further into the future. Time matters. Question 3. What risk am I being paid for? Am I being paid for lending longer? Am I being paid for lending to a risky borrower? Am I being paid because inflation is high? Am I being paid because markets are uncertain? Yield is not just income, yield is information. A very high yield may look attractive, but it may also be the market warning you, something here is risky. That is why chasing yield without understanding risk can be dangerous. A beginner should not just ask, how much does this bond pay? A better question is, why does it pay that much? That one question can protect you from many mistakes. Now, here's the biggest lesson. Bonds teach you that money has a price. If you borrow money, you pay the price. If you lend money, you receive the price. That price is interest. Interest is the cost of using someone else's money. This is why debt can be powerful or dangerous. If you borrow money to buy something that loses value, interest can make you poorer. If you borrow carefully to buy or build something productive, interest may be part of a wealth-building strategy. If you lend money through bonds, you become the person collecting interest. So the financial system has two sides, the borrower side and the lender side. Most people spend their lives on the borrower side. Credit cards, car loans, personal loans, buy now, pay later, mortgage payments, student loans. But wealth builders try to move toward the ownership and lender side. They want assets, they want income, they want interest working for them, not only against them. That does not mean debt is always bad. And it does not mean bonds are always right for everyone. It means you should understand the game. Because if you do not understand interest, you will keep paying it without realizing how powerful it is. And bonds are one of the cleanest ways to understand interest. Here's a simple picture. A borrower says, "I need money today." A lender says, "I will give you money today, but I want more money later." The bond is the agreement between them. That agreement tells you the price of time, the price of trust, the price of risk, and the price of money. That is why bonds matter. So the next time someone says bonds are boring, remember this. Bonds tell you what money costs. Bonds tell you what risk costs. Bonds tell you what time costs. Bonds tell you what trust costs. And if you understand that, you understand far more than just bonds. You understand why your mortgage changes, why your savings account rate changes, why companies borrow or slow down, why governments pay interest, why stocks react to interest rates, why inflation matters, why debt can trap people, and why wealth builders respect the power of being paid interest instead of only paying it. If you want to understand money, do not skip bonds. They may not be flashy, they may not be exciting, they may not make viral headlines every day, but they are one of the foundations of the financial world, and once you understand them, the entire money system starts to make more sense. This video is for education only and is not financial, legal, tax, or investment advice. Bonds involve risks, including interest rate risk, inflation risk, default risk, and market risk, so always make decisions carefully and seek qualified guidance when needed. We post a new video every day on The Wealth Shift, so subscribe for everyday financial lessons that help you avoid money traps, build better habits, and grow real wealth. Shift your money, shift your future.